Welcome to the next installment in our lecture series here at Rutgers University for the American Economic History course online. And in this video lecture series, we are reviewing Chapter 23, I believe, and it's referring to normalcy. It's talking about the period between the end of World War I and the beginning of the Great Depression, the Great Crash in 1929. So, and the reason that we talk about this return to normalcy is because of, as we talked about in the previous chapter, is that there was a great deal of governmental control over resources that occurred during World War I. And so it was looked at, number one, that the government was moving back away from having a great presence in the economy, and two, that you return to the normalcy post-war. So we're going to look at this period that includes the Roaring Twenties and to see what important components, what important things occurred in this era prior to the Great Depression. Number one, and that first bullet point is very important to understand. There was an expansion in the use of consumer credit in the economy during this time period. Before this, people mostly paid cash. There was very little consumer credit. The credit that existed was for large corporations and for merchants, etc., but there was no such thing as consumer credit. During this period, we see a great expansion in the use of consumer credit, and we want to understand what was the role of that. Why was the expansion of consumer credit a major cause towards the expansion of the economy that occurred from 1919 to 1929. We also want to take a look at how the economy performed in this period leading up to the Great Depression. All right, it's important to understand what the economy looked like prior to 1929 in terms of output. By that I mean GDP, how the value of goods and services that were produced in the economy during that time period. What happened with prices during this time period, and what did unemployment look like during this time period. So we want to be able to understand what the general level of economic activity was, what the inflation rate looked like, and what the employment picture looked like prior to 1929. So it gives us a reference point as to how big of a change, how drastic of a change in the economic conditions that occurred in the 1930s. We also want to take a look at the economic state of particular sectors of the economy. And here we're going to stress farming and construction, but also take a look at financial. The reason why we want to take a look at farming and construction is that many people believe that the farming and construction industries were very weak in the 1920s. Even though the economy was growing fairly briskly during this time period, the farming sector, and the construction sector were not doing as well as most people thought. And a lot of people place this as part of the cause of the Great Depression, that these two sectors of the economy, which were very important, farming was still a very important component of GDP during this time period. All right? So we need to realize that farming and construction made up a good proportion of the economy, and if they weren't doing well, they signaled fundamental instability in the economy. And we'll also talk about how the financial sectors and financial markets changed in the 1920s. And finally, we'll just take a view of some of the potential causes of the Great Crash. Now, you notice that I said potential causes of the Great Crash. One thing I want you to realize when we talk about the Great Crash is that there is no one factor that caused the Great Crash. All right, it was a conglomeration of a number of things. For example, you could argue that weaknesses in the farming sector contributed to the Great Crash. That it's because farming was still such a large component of GDP, that with the farming sector not doing well, it showed that the economy as a whole was weak. All right, we can talk about the stock market crash as a cause. We could talk about the banking crisis as a cause. We could talk about the collapse of consumer spending. We could talk about the Hoot-Smalley tariff that occurred. There's a number of things that occurred during this time period. Weaknesses in the banking sector. There's a whole host of things. So I want you to realize that when we say causes, In my eye and in my mind, you can't attribute the Great Crash to any one cause. There was a whole host of things that occurred, and it's one of the reasons why the Great Crash was so devastating and the Great Depression lasted so long. Lasted pretty much a decade. We did not get back to the same levels of production for a very, very long time. We didn't even, by the time we got to World War II, unemployment rates were still incredibly high 10 years after the Great Crash. So that's some of the things that we're going to talk about in another lecture is, the severity, the depth, getting a perspective on how bad the Great Depression was. But here we're talking about the lead up to the Great Crash and the Great Depression that occurred. I want you to realize that when we take a look and take an overview of the economy, between World War I and World War II, the economy of the United States was all over the place. All right, from 1919 to 1929, it's referred to as the Roaring 20s. Economic activity was pretty stable. We saw growth, and some people thought that was apparent going to be unlimited. Major economists at the time were talking about how we had reached a plateau and we were going to have unlimited growth in the future. We wouldn't have anything to worry about, etc. And then 1929 hit, the stock market crashes, and then into World War II, we see the exact opposite, a long, entrenched depression. All right? Realize that during the Great Depression, the unemployment rate reached somewhere between 20 and 25% in some years. All right. Recently, we had the unemployment rate as double digits or getting close to 10, and people were up in arms about that. So I want you to realize the scope and the depth of the Great Depression. So this period, the interwar period between World War I and World War II, we see a very mixed economy. We see an economy for 10 years that looks like it has unbounded growth and there's optimism in the economy. And then it's followed by the 30s, where the economy is basically in the toilet. The economy does very, very poorly. So I want you to realize that about the interwar period. You have two distinct phases. A 10-year phase where it looks as though there's going to be unlimited growth and low unemployment and low inflation and GDP constantly growing. And then we hit the Great Crash and the Great Depression where the economy tanks and we end up in a depression for 10 years. I want you to realize that the Roaring 20s, as we talked about before, it was a strong growth period, all right? But there were very many weaknesses, particularly in farm and construction sectors. There were two very weak sectors of the economy throughout, and it seems that a lot of those weaknesses were masked by an overall improvement of the economy. But realize, as it says here, nothing individually explains the downturn of the 30s. So whenever I talk about the factors leading up to this, realize that there's going to have to be a multitude of factors. If I ask you to talk about the Great Crash or the Depression, the Great Depression, don't stress on one factor. You have to make sure you mention multiple factors as causes to the Great Crash and the Great Depression. Number one, you have to realize that the importance of consumer credit. We take consumer credit for granted nowadays. All right, if I pull my wallet out, I can pull a credit card out or any number of credit cards, and I can buy stuff without physically having any money. The credit card company, the bank itself will lend me the money on short-term credit, and I have to pay them back eventually for that. So we take it for granted the availability of consumer credit. And most people have some type of credit card or form of credit available to them. So realize that in the 20s, it was a time when consumer demand shifted. There was an increase in consumer demand because of the availability of consumer credit. And that's something I want you to understand. It's something that's very important. That when you allow individuals to buy on credit, it increases their demand presently. All right? Imagine if you had to pay cash for an automobile. What do you think the demand for automobiles would be relative to the fact that you could borrow money to buy cars? If I were to take away consumer credit and force people to buy cars on a cash basis, right now, there would be a dramatic decrease in the demand for automobiles because most people don't have that kind of cash lying around. All right, some people are fortunate enough to have $20,000 or $30,000 lying around to purchase a car. But if you do that, and that's the argument that I'm making, imagine the scenario where you have consumer credit and look at the demand. If you take that consumer credit away, what happens to demand? Demand dramatically decreases. So if we move in the opposite direction, if we go from a scenario where there's no consumer credit and all of a sudden we introduce consumer credit, people can buy things on an installment basis. The demand for the goods that credit is available for increases. All right, so realize that first point there, that the introduction of consumer credit in the 1920s physically shifted the demand curve to the right, increased the demand for consumer goods that could be bought on credit. All right, so that is one area that economists often talk about as to why we saw a dramatic expansion in the economy in the 1920s. The availability of consumer credit was a stimulus to demand. All right. Also, the fact that there was the introduction of technologies, particularly there was the electrical grid was getting up and running, so electrical power was spread out through the entire economy. So it was more and more prevalent that people had electricity, and the internal combustion engine was becoming more prevalent. So we start seeing more automobiles. We start seeing more electrical appliances, etc. So make sure you understand those two things, that it was a innovation in terms of consumer credit that shifted demand, but there was also these technologic changes that occurred, electrical power. All right, you might not think that that's a big deal, but if you have electrical power, what now do you have a demand for? You have a demand for appliances that use electricity. So you can buy a washing machine, you can buy a radio. No televisions back then, no internet, etc. But a radio, record players. I'm old enough to remember record players. I don't know if any of you guys are old enough to remember record players. So realize that there was introduction of technologies out there, and there were goods related to them that increased demand during this time period also. So we have consumer credit enhancing demand, and the introduction of technologies that will increase the demand for dependent products. So for example, electrical power. Once you have electrical power in your house, you can buy a washing machine for your clothes washing machine. Instead of doing wash by hand on a washboard, you can buy a radio, you can buy light bulbs, etc., lamps. All those things are going to increase the demand because they are complementary goods to electrical power. Make sure you remember this term, general purpose technologies. For example, electricity is a general purpose technology because it performs a general function to a wide range of products. For example, oil, gasoline are general purpose technologies because they can be used in cars, they can be used to heat your home, they can be used for a number of things. I guess electricity is a better example in the terms of a general purpose technology, because if you think about that, think today, of all the things that you use that require electricity, your phone in your pocket, you got to charge it, your computer, the lights, your car, getting your car started, etc. All those different types of things, lights, any number of things, your TV, internet access, all these different things require electricity. So make sure that you realize that these general purpose technologies also the availability of these general purpose technologies, particularly electricity, enhance the demand for a lot of products. And we see a lot more people buying automobiles, radios, washing machines, refrigerators. Important thing. I am old enough that I remember people who didn't refer to a refrigerator as a refrigerator, they referred to it as an icebox. I know people, older people to this day, that refer to refrigerators as ice boxes. The reason why they were called ice boxes is that's what you needed. You had to buy ice. You had an iceman that used to drive around, and you would buy blocks of ice to place in your ice box, and that would keep your foods cold. So you could buy vegetables, etc. But then, of course, the ice would melt, and you'd have to buy more ice from an individual. So realize that those general purpose technologies, that the availability of electricity, once you get electricity, you have a demand for a whole host of other products that are only useful with the availability of electricity. So realize that the change in consumer credit and the availability of these general purpose technologies as impetus for why the economy did so well in the 1920s. Installment contract. Make sure you remember the term installment contract. Basically, they would let, if I wanted to buy a car, or if I wanted to buy a refrigerator or a radio, etc., I didn't have to pay cash up front, but I would have to pay a certain amount every single month. So that's what I mean by installment purchases. You make a down payment, then you have to pay a certain amount every month. It's just an example of consumer credit that was available. So what was the impact of consumer credit? We say that consumer durables, and by consumer durables I mean things that last for a long time. An example of a consumer durable is a computer. All right, you can use that item over and over again. If you buy a car, if you buy a washing machine, if you buy a dryer, they are higher cost items that you use over and over again. They don't cease to exist after you consume them. For example, if you go down to a vending machine at Rutgers, or you buy a soda at the student center, when you consume that soda's gone. But you can use that computer over and over again. You can use that car over and over again. That's what I mean by consumer durables. All right. So during the decade, consumer durables purchases increased by 8%, while the economy as a whole grew by half that rate. So I want you to realize that the purchase of consumer durables increased by twice the rate of the entire economy. Let's see, 25, just to give you an example of some numbers. In 1925, 75% of cars was bought on consumer credit, 70% of furniture, 75% of radios, and 90% of pianos were bought on credit. Now, these might seem like low numbers to you because everybody uses, for example, I would imagine close to 100% of cars are bought on consumer credit now. Radios, who even buys radios anymore? It's an outdated technology, correct? So just realize that how important that consumer credit became to these durable good items. And this is a big shift for consumers. Before, you had to save that money up and save enough money to buy a car, or save up money to buy furniture or a radio or pianos. And instead of saving up money, you could purchase them right now, consume them, and pay over the next few months or over a year to pay off what you owe on that car. Outputs. Make sure you realize, number one, that the automobile industry was a major growth sector in the 1920s. All right, automobile production increased dramatically. Manufacturing during the 20s. Manufacturing output doubled during the 1920s. So manufacturing output grew at roughly 7% every single year. That's a fairly robust expansion. All right. Just realize that this was not a continuous growth spurt. That in 1920-21, that there was a recession. But realize that there's a common theme here, that once we move out of a war and all that wartime spending that actually occurs, you generally run into a post-war recession. If you look at World War I, if you look at World War II, if you look at the Korean War, etc. If you look at those wartime periods, generally you will see that there's a post-war recession because of the fact that during the war the government is buying up a lot of resources. There's an increase in demand for resources. It drives up prices, etc. But there's a dramatic increase in production because the government's purchasing that many more resources. And then when the government stands down from war, the demand decreases and you see decreases in the production levels. So realize that when we talk about the 20s as being a growth period, the beginning part of the 20s did not start off very well. There was a very severe post-war recession, and because the World War I ended in November 1919. So in 1920 and 21, we see a post-war recession. Let's just take a look at money, prices, etc. during this time period. So what do we see? Let's take a look at consumer prices. Here's the Consumer Price Index. All right, we see a dramatic increase in consumer prices here. about a 16% or 15% increase, but then prices fall in 1921, so that will be indicative of the recession or the depression that we saw in 2021. There will be a dramatic decrease in price, and after that, what do we see? We see relatively, stable prices. I mean, they do peak a little bit in 1926, but the prices remain pretty stable. So one of the things I want you to realize about the 20s is it's a period of stable prices, that there's not a high level of inflation like there was during World War I. What do we see on the wholesale price level? If we take a look at, again, 1920 to 1929, we actually see that once we get out of that recession, 2021, if we start at 1921 and go to 29, again, we see that wholesale prices, once again, are relatively stable. We don't see dramatic increases or decreases. The interesting thing that we end up seeing is there is a dramatic increase in the money supply. If we go from 21 to 29, there is almost a 1/3 increase. So if let's say 25% increase in the money supply, and that does not translate into higher wholesale or consumer prices. And a lot of people argue that, number one, even that this increase in the money supply should have caused higher levels, higher price increases during this time period. And the argument that there was great increases in productivity, that there was a large level of investment in the capital stock for World War I. So 1918, 1919, there was capital investment to try and produce more and more goods for the war effort. So there was a level of excess capacity that existed in the economy. So this excess capacity was able to absorb the increases in production that would have been caused by the inflationary pressures that would have been caused by the increase in the money supply during the 20s. So this increase in the money supply didn't cause inflation because there was excess capacity left over in the economy from the buildup that occurred during World War I. Also realize that when I talk about that recession from 20 to 21, severe, short but severe, and realize as a comparison, prices fell more in 1920-21 than they did at the beginning of the Great Recession. So that's one of the things, that we will try to address is what was so different between 2021 and 29 and 30? Why was it that this started so poorly and the economy recovered after this recession? While if we take a look at 1929 to 30, it wasn't as bad as 1920-21, but we end up moving into the Great Depression. All right, so I already discussed this, that wholesale consumer prices were stable in the face of strong economic growth and money supply. And again, the explanation was there was a strong increase in investment and capacity left over from World War I. So the growth in the money supply wasn't inflationary because of the excess capacity left over from World War I. And even with a 25% growth rate in the money supply, you actually see prices declining during this time period. Also note that what happens that we have prices declining, but workers' wages in real terms, their purchasing power increases. So I want you to be aware of that the working class was doing better during the Roaring 20s. From 1922 to 1929, we actually see real wages increase by about 17%. So wages were increasing faster than inflation, and the purchasing power of workers was increasing during that part of the 1920s. One other thing I want to talk about is the Prohibition and the introduction of Prohibition. It's important because from an economic perspective, I'm not talking about a policy perspective, that the brewing industry and the liquor industries were quite important. So basically, Prohibition eliminated wholesale sections of the economy in the 1920s. All right. As a backdrop, just realize that Congress mandated Prohibition during the war in 1917, mostly to attempt to preserve grain supplies. You need those grains to make bread. You need wheat, barley, etc. So Prohibition was mandated as a governmental control during the war in order to maintain the food supplies. All right, the same year, a constitutional amendment was passed, and 3/4 of the states ratified prohibition. 3/4 of the states agreed that it should be illegal to produce and consume alcoholic beverages in the United States. And then after this was passed, they had to pass the Volstead Act, which gave the law which gave the guidelines for the enforcement of the constitutional ban. So make sure you remember the Volstead Act is the mechanism that provided guidelines for enforcement in order to enforce prohibition. Realize that people easily evaded this. Some people even argue that the rise of organized crime was attributable to the fact that there was prohibition. Many of the early quote-unquote gangsters, for example in Chicago, Al Capone, made a good portion of their money in providing illegal beverages to individuals. So some people argue that consumption really didn't decline that much, but it caused enforcement, increased enforcement costs on localities. Also, if you don't allow beer and wine and alcohol and strong spirits to be produced, what does that do to the tax revenues that come from liquor taxes? So this adversely affected local governments because they no longer had those liquor taxes coming in. You get rid of all the industries that are producing those beverages. There's job losses that are associated with prohibition. And the thing with prohibition is the proponents argued that if you enacted prohibition, there would be a dramatic increase in labor productivity. Their argument was that so many people were getting drunk that it was decreasing, or the excess use of alcoholism caused decreased productivity on the job and increased absenteeism, which decreased worker productivity. If you pass prohibition, we will see a dramatic increase in labor productivity. But that increase in labor productivity never materialized. If you take a look just overall at unemployment, the unemployment rate averaged about 5% during the decade. Also, 1919, 23, 26, and 29 were considered full employment. The employment rate was equal to the natural rate of unemployment. Remember, there's always going to be some positive level of unemployment. There's people who lose their jobs and it takes them time to find new jobs, etc. So full employment doesn't mean zero unemployment. It just means that that the unemployment rate is equal to the natural rate of unemployment. And realize how much GDP grew. GDP grew by 60% over an 8-year time period. So roughly about a 7% increase, 6 to 7% increase in GDP annualized between 21 and 29. So what was the economy categorized as? So you had a vigorous expansion, a very strong expansion of the economy during the 20s. You had stable prices. You had rising real wages. People in the working class were getting higher wages relative to inflation, so their purchasing power was increasing, and the economy was close to full employment for much of the decade. So I want you to realize that about the economy in the United States in the roaring 20s. It was a very strong expansion. Prices were relatively stable. Incomes of the working class in real terms were increasing. All right, their nominal wage increases were greater or in excess of the inflation rate, so their purchasing power increased, and the economy was close to full employment for much of the time. So let's take a look at some of those numbers here, and you can see that after we eliminate 1921, 2021, I mean, you could see how severe that recession is. The unemployment rate doubled in 1 year, went from 5.2% to 11.3% in 1921. And then after a slight adjustment in 22, it lowered from 23 to 29. You could see that the unemployment rate is pretty good. Only once does the unemployment rate exceed 5%, and in one instance it actually falls below 3%, actually in 26 and 29. So you could see, compared to modern standards, if we take a look at, for example, 23 to 29, the highest the unemployment rate gets is 5.3%, and the lowest it goes is to 2.9%. So we can see in terms of unemployment, unemployment's not an issue. We can see that gross domestic product, if we do the same time period, increases pretty much consistently, except for 26, 27, and 28. All right. And that should have been some indication prior to that, that we had 2 years of stagnating growth before 1929. All right, so some people argue that if you take a look at these numbers here, the economy shrinking and it's not growing at all. Some people should have realized that this was that there was trouble brewing for that. But that's nominal GDP. I apologize. I shouldn't really go over that. We have to take a look at real GDP, and you can see from 23 to 29 that real GDP grows every single year. So we have constant growth in GDP. We also see what? In a per capita basis, per capita GDP grows during the time period. And what do we end up seeing on the budget and deficit side? We see that the government's actually running a surplus for much of the decade. So you can see why some people refer to this as the roaring 20s. We have low unemployment, stable prices. We don't have high rates of inflation. We see the economy growing consistently from year after year, and the government was running on most, actually for every single year, was running a budget surplus. All right, so realize that from the fiscal results. The government ran a surplus every year. Last year that they ran a deficit was 1919. The federal government had a budget surplus until 1931. And this had a mildly deflationary effect, all right, because that's less government spending. If it had spent the surplus, actually the economy would have grown even faster, but that would have put increased pressures on the inflation rate. Government expenditures were kept in check, all right. And with the income tax, the government had new levels of funding and had the incentive to spend those revenues. One of the issues that's often brought up is that of income inequality, and people argue that with a growing inequality in income undermines the economy and help to contribute to the Great Depression. All right. In the 20s, we see this long-run trend of increasing inequality resumed. During the wartime effort and wartime financing from 16 to 17, we actually see a redistribution of wealth, and the distribution of income becomes more equal. There's fewer people making the most money, and there are more individuals. The distribution of income is more equal, but in the 20s, the long-run trend that had been occurring prior to the war resumes, that the distribution of income is getting less and less equal. All right. So realize that's one of the arguments that undermine or sort of illustrate that there are some weaknesses in the economy, that the distribution of income was becoming less equal in the 1920s. The other thing that some people argue is that weaknesses in the farm sector, and that these weaknesses in the farm sector from the 20s was a major contributor to the Great Depression in the 1930s. All right, farmers had long felt that they were falling behind, even in the late 1800s. And this led to a couple of associations. For example, farming cooperatives were oftentimes sued as being anti-competitive. So the Capper-Volstead Act lifted the threat of antitrust prosecution for farm cooperatives. And it allowed them for output restrictions and to have some control over pricing. Now the farmers felt aggrieved through this entire situation. Why is that the case? The value of farm output consistently fell. Here it shows you by 41% in 1921 to declining prices. The reason for this is that farm prices, as we talked about in the previous lecture, were going up during World War I. That there was a decrease in the supply of those products caused by the dislocation in Europe by World War I. So with the decrease in supply by certain regions, that the prices of farm products generally went upwards, so the farmers were better off by these higher prices. Once the war was over, we end up seeing that those prices return to their pre-war levels. And this was mostly due to declining prices. So as prices were falling dramatically, the farmers didn't produce all that much less, so they see their revenues dropping dramatically post-World War I. All right, so we see that the value of farm output is decreasing. All right, also during this time period, the fixed costs that were imposed upon farmers rose dramatically, from 5.4% of revenues to 12% of revenues. So for example, the argument or the explanation for this is a lot of farmers, in order to take advantage of the fact of higher prices, sought to increase the acreage that they had. So they borrowed money in order to increase the acreage that they held, which increased their mortgage payments. So the debt that farmers held increased, and after the war, they had fixed debt payments that they had to make, but their revenues were falling. It would be the same example as you having a fixed rate mortgage, and having to pay $2,000 a month for your mortgage. You have that $2,000 a month payment. What happens if you lose your job and have to take a lower paying job? That mortgage payment is going to take up greater parts of your income and your revenue. Same situation for the farmers. All right. And the farming sector decreased in importance. All right. In 1920, it was 18%. By 1929, it was 12%. So realize that even though the farming sector was decreasing in importance, it still accounted for 12% of GDP in 1929. So just realize that the weaknesses in the farming sector, the fact that prices were falling during the 1920s in a time period where farmers saw higher debt payments, really caused the farmers to suffer during this time period. All right. So you can see this is just illustrating, for example, net farm income. In the 20s, you see that farm income. In 1919, farm income is maximized, and you can see that prices received is going down, which is causing the revenue, the income that farms receive, to fall. All right, and as you can see, in 1883, interest per acre was at 83.3, and as you can see, during this time period of the 20s, early 20s, that their interest payments were increasing, and their taxes were increasing during the same time period. So the amount of interest that farmers were paying and their taxes per acre that they were paying were increasing during a period where their incomes were falling, and their incomes were falling mostly due to the fact that farm prices were falling. Construction industry. A lot of people argue that the construction industry had some issues. The reason that they argue the construction industry had issues is because the cost of construction remained constant during this time period, and we do see increases in construction, but by 1926 to 29, we see that the construction industry starts in decline. So in a period where their costs are remaining constant, the number of permits issued is declining, and the total value of new construction starts to fall. So this decrease in permits and the decrease in total construction is not a phenomenon at cost. All right, well, they weren't causing them to restrict supply, that there were other reasons why new construction was decreasing during the time period. It can't be attributable to costs. And some people would argue that if your costs are remaining constant, the cost of doing business are constant, and you see the value of production decreasing, that's giving you an indication that the building trades themselves, the sector is weak. Just want you to be aware of some of the other indices that are out there. GNP, you can see that moving out of the war, GNP falls by, you can see that from 20 to 21, it falls by 23%. So you can imagine if GDP or GNP in the United States fell by 23%, be a dramatic decrease. And you can see the fall in wholesale prices. But just realize after that point, after 22 to 29, you can see that GNP is consistently increasing over time, that wholesale prices are relatively consistent during that time period. The other thing I want you to be aware of is look at what's happening to the stock market. So even though, for example, GDP is growing fairly robustly, the stock market totals are growing. The index of stock market values are increasing dramatically. Particularly, let's take a look at 26 to 27. We actually see GDP falling during that time period, but the value of common stocks actually increases by about 20%. So it looks as though even as early as 1926 that the value of stocks had lost any relationship to how well GDP was going. Here we see that the economy, GNP, increases from 1.37 to 106, which is roughly, it's less than a 2%, let's say a 2% growth rate. And here we see that the value of common stock is increasing by 40%. No, 25%, I'm sorry. So you can see that the stock market is growing faster than production, the value of production in the economy. And this continues. We go to 28 to 29, that's 6. The GNP is increasing by 5%, and we see a 30% increase in the value of the stock market. So some people argue that this speculative mania, this bubble in the stock market, started roughly in 1927, and it lasted for 2 years, and it finally popped in 1929. That the value of stocks from 27, 28, and through 29 bore no relationship to how well the economy was doing as a whole. All right, and let's take a look at number of business firms during the time period. We see slight growth. Sort of stagnating. Failures is relatively consistent in the 1920s. All right. Let's take a look at bond yields and stock yields. Also, remember the stock market is dramatically increasing, particularly from 26, 27, and 28. But stock yields for utilities is declining, as well as it is for railroads and for industrials. So the industrial companies, their stock yields are falling during a period when stock prices are going up. The same thing for rails and for utilities, all major sectors of the economy. So if you think about that, it seems like that the yields on stocks, particularly the industrials, rails, and utilities, bear no relationship to how fast stock prices were going up. Stock prices were going up dramatically when the yields, the dividend payments to these particular important sectors of the economy were falling during the latter stages of the 20s. All right, stock market. Let's take a look at this a little bit more in detail. And again, let's look at 26 and beyond. As you can see here, stock market was growing fairly well. The industrials were growing well, etc. Let's take a look at 26 through 29. And I said you can see the total stock market. You see dramatic increases in the value of stocks through 1928. The totals, you can see here that almost a 30%, 25% increase in the value of stocks when the economy was only growing by about 5%. All right, we see that's common across all these stocks. Industrials, the stock prices, dramatic increases. Rails, not as much, but still an increase. And the same thing for utilities. So I want you to realize that it seemed like, I don't want to say people lost their senses, but there seemed to be a disconnect between the level of economic activity in the economy and the value of stock prices. Stock prices were increasing faster than GDP or GNP was increasing. So, I mean, that could be an indicator that the stocks were undervalued for a significant time period, but you can see that for a period of 2 to 3 years, consistently, the stock prices were outperforming GDP. And some people argue that that's an indication that this speculation, this mania that stock market prices were always going to go up, started in 1926, and it was sort of a self-fulfilling prophecy, that people wanted stock market prices to keep going up, and they kept buying stocks, and that drove prices up. But at some point, people started to realize that these stock prices don't reflect the reality of the economic condition. And once they started dumping these stocks, you started to see stock prices fall and fall dramatically. Now the crash occurs, 1929, the stock market crash. So the question always is, could they see it coming? Well, an economist named Roger Babson did. He actually predicted the stock market crash about a month before it occurred. Very vocal in saying that the stock market prices were completely out of whack with the economic reality, and at some point people would have to start selling off when they realized this, and there would be a decline in prices. Roger Babson was universally ridiculed for his statement that the stock market crash was going to fall. Some people argued that he was selling short, meaning that he bet that the stock market was going to crash and that he was going to make a great deal of money if stock market prices fell. So he was making that prediction in the hope it would happen. I mean, there were a number of well-known economists who rebutted Babson and saying that he was ridiculous, that we were at a plateau of economic activity. Stock market prices are going to be at a perpetual high. All right? So just realize that. The other thing is that economics and trying to predict stock market crashes, there was a lot of economic inertia during this time period. There wasn't a lot of hard-scale economic analysis of the stock market. So the economists at the time this is something they weren't really looking at. And also, John Maynard Keynes uses this expression, animal spirits. It has a tendency for humans that if things are going well, they will continue to go well. So for example, if the stock market has been going up in value, it will continue to go up in value. Therefore, I should buy stocks. Same thing with the housing market recently. Housing prices are continually growing year after year. Therefore, they will always go up. Therefore, I should buy stocks. And so I should buy houses. I should invest in real estate, and I'll make a killing because of that. So realize that is an issue that occurred, and is an argument that people sort of lost sense of the reality of the stock market prices relative to the economic condition of the time. Some causes. Let's go over some causes of the speculation. Particular brokers' loans are listed as a major example of what helped to fuel speculation. A broker loan, oftentimes also referred to as a margin loan, is where you can buy a stock without having to put the full purchase price up. Your broker will lend you the remainder of the money. So you only have to put a portion of your money towards purchasing a stock. What you do is you use the stock itself as collateral towards the remainder of the payment. So for example, let's say I was going to buy a share of stock for $100. All right? And the margin on that loan is 10%. I can buy that share, give my broker $10, and the broker will lend me the remaining $90 in order for me to purchase that loan. So it allows me to purchase stock when I don't have the full purchase price up front, but it also gives me leverage because I can buy stocks at a much higher level. If my broker is going to lend me 90% of the purchase price, I can buy 9 times as many shares if I had to buy the full purchase price. If I had to put the entire $100 up, let's say I had $100. And the stock cost $100. If there's no margin loans, I can buy 1 share. All right? If my broker is going to lend me 90% of that, I can buy more than 1 share, can't I? I can buy 9 shares or 11 shares. I can buy much more shares. So it increases the demand for speculation in the stock market. All right, I want you to realize with these margin loans that your broker is lending you the money and you're using the stock as collateral. This causes a major problem when the stock market starts to crash because remember, you're using the stock as collateral against the remainder of the loan. When the stock price falls, you need to raise more collateral in order to cover the loan. All right. So if I borrowed that money and the price of that stock was 100, all right, and it falls to 50, I got to come up with $40. So I have to collateralize the rest of that loan. I have to come up with the cash to give my broker in order to properly securitize the loan. If you don't have the money, what do? You sell the stock. This happens to a lot of people, and a lot of people sell stocks because the price is falling. If you sell more stocks, stock prices continue to fall, which causes other people to have to make collateralization payments on their broker's loans or liquidate the stocks. So you see that this speculation and use of margin loans, when stock prices start to fall, causes round after round after rounds of successive selling in order to cover the margin. It was called the margin call. That if your stock price dipped below a certain amount, your broker would call you and ask you to collateralize the remainder of your loan, the difference between what you were loaned and what the value of the stock was left over. All right, these broker loans also realized that a great deal of the money that was flowing into these margin loans or broker loans were coming from companies. The interest rate that they could get on these margin loans, these broker loans, was much higher than other investments in the economy. In some places, the margin rate was 15%. So why would you invest in a new capital or new plan for your company with an expected payment of 5% when you could just lend that money into the call market and get 15%? So what happens is that because there was such a great disparity between on these I call them call loans, sometimes I call them margin loans, sometimes I call them broker loans. They're all the same thing, the call market. So instead, what was happening is a lot of money was coming out of corporate accounts and going into the broker's loans and helping finance the speculation that was occurring. So what happened is that these companies, instead of investing that money in capital and building more plant and machinery and investing in new capital or upgrading their plant, etc., that money wasn't investing in the capital stock of the company and the country, it was investing in speculation. So some people argue that these broker loans, in particular the corporate money that went to the broker loans, siphoned off investment funds for companies during this time period. Also realize that there was a proliferation of investment trusts. If you want to think of investment trusts, think of it very much like a mutual fund. It was a company set up to buy stocks and group stocks together. All right, so if you think of an investment trust as a mutual fund, that's the best way to think of it. They pooled individuals' resources and bought groups of stocks as a particular entity. There are benefits to this, right? It spreads risk out. If I have $100 to invest in the stock market, I might be able to only buy one stock. That stock goes under, I lose all my money. But if I have $100 and buy shares in an investment trust or a mutual fund, and that mutual fund buys 1,000 shares of stock of different companies, one company failing is not going to ruin me. So there are benefits that it spreads the risk out for individual investors. The problem with that is, number one, it made it easier for people to invest and spread out risk, which means that there was an increase in demand for stocks, which drove up stock prices. The problem with these investment trusts is that there's many of them were engaged in large-scale fraud. For example, there were investment trusts that were invested in investment trusts, that were invested in another investment trust, etc. In essence, an elaborate Ponzi scheme is basically what they were involved in. And these trust companies didn't own stock, but they owned stock in other investment trusts. So realize that these investment trusts as a financial innovation, anytime you have a financial innovation, some level of fraud was going to occur. The problem with this is that fraud occurred on a large-scale basis. The fact that these investment trusts were allowed to interlock with one another and invest in one another meant that if one investment trust failed, then a whole host of investment trusts would fail. And I already talked about the margin calls. When stock prices fell, you had to collateralize a loan with your broker. It means you had to give them extra money. If you didn't have that money, he would liquidate your portfolio in order to get the money that was owed to him. What happens is that when these margin calls go out in a great amount, they put downward pressure on stock prices, which the next day further more margin calls. And then when you see a dramatic decrease in the price, you see margin calls going throughout, and there's a large-scale liquidation of prices of stocks, just like occurred in 1929. So we talk about some major causes of this, and John Kenneth Galbraith is the source of these major causes, that this unequal distribution of income contributed to the Great Crash. That when you had fewer people, for example, purchasing necessities, if you double the income of wealthy people, they don't buy more milk and more bread and more these other things. But if you increase the income of the middle class and the working class, they are going to consume more of these types of items. So they will be less. They will be more likely to purchase goods and services of a certain type. So his argument is that the unequal distribution of income and the increasingly unequal distribution of income was a contributory factor. The unstable business structure, that there were innovations that occurred and there was often poorly structured companies that existed during this time period. Also, from a financial perspective, these unstable business organizations that resolve and relate to fraud with investment trusts. The banking structure was very weak. The banks weren't very strong. So once there was a shock to the financial system, i.e. the stock market crash, this impacted the banking structure dramatically and caused further problems. There was also international financial issues at play here. The gold standard and a few other things that caused the gold to flow out of the United States, which further decreased the money supply, which further depressed prices. And the fact that there was large-scale economic ignorance. People just didn't understand how to analyze the situation from an economic perspective. That economists just, they never saw an economic downturn this severe, so they didn't know how to address that economic downturn.